The euro dollar pulled back below the 119 mark following the 7-month high non-farm payroll print, which boosted the DXY back above the 97 mark and capped gains across precious metals and major currency pairs. Market attention now shifts towards today's US CPI report to be able to test the sustainability of these rebounds. Now, the latest bullish rebound on the US dollar index is not only supported by the 7-month high non-farm payroll print, but also by the extended weekly wick back in at the end of January 2026, which was not able to sustain lows near the 95 mark, closing back above the 97 zone. And this zone is very critical for the US dollar index, as it is a defining zone, which is the 96 to the 95 mark, between an 18-year uptrending structure or parallel channel and the potential structural breakdown. So as long as we're holding above this bound, we're expected to have a potential bullish continuation bias, and the clean hold below this mark, below the 95 level, is expected to have a structural bearish shift to the downside, extending US dollar index losses all the way down towards 92 and 89, lows last seen in 2021, which can be replicated as a positive impact across currency pairs and precious metals. Now, from the upside, a clean hold above the 99 and 99.50 to the 100.40 mark, which was a previous support for price action since February 2023, and the resistance between 2025 and 2026 can reassert that bullish bias continuation on the charts, capping the overall gains seen across major currency pairs. Now, if you look at the euro dollar chart from a monthly time frame, we can see that also that extended wick to the upside was not sustained, with prices closing back near the 1850 mark. Now, a clean hold above the 1950 level is needed, at least a weekly close, to be able to extend these bullish forecasts towards the upside above the 120 mark. We can see price action now capped below a trend line connecting consecutive higher highs between July 2025, September 2025, and January 2026, which needs a clean hold above this mark to be able to extend the highs or possibly target gains towards the next key levels in sight, which are the highs of 2021, and we'll be talking about the 122.50, and a clean hold above that is expected to extend gains towards the highs of January 2018, which were near the 125.50 mark. Now, if we look at the relative strength index indicator, we can see that we're hovering from a monthly time frame perspective near overbought levels last seen in 2021 and in 2018, which preceded also extended drawdowns on the charts, which is also raising caution for a potential an extended drawdown in line with the DXY's bullish hold above the bounds of its 18-year structure. Now, from the downside, should the euro dollar close back below the 1780 and the 1580 marks, we might be extending a drawdown all the way down towards the support zone between the 111 to the 112, which was a previous resistance to price action between 2023 all through 2024 for potential dip buying opportunities for extending deeper downside risks on the euro dollar pair. The defined key levels remain in focus to be able to differentiate between short-term volatility risks and long-term structural shifts on the charts.